Hello, it's Cryptolyze. I hope you are well this Sunday, 31 December 2023. We're meeting together for the last day of the year 2023 to make the second part of the video on how to X100 on a bull run. Overall, it's a continuation of the first video I made for you. Yesterday, I really invite you to watch it. I will put the link at the end of this video. If you haven't had time to watch it, you absolutely have to watch it to understand the evolution of this video, because here we are mainly going to talk about how to take your profits. You understand that it's all a question of risk management, to be able to make multiples, to be able to progress. This is how you are going to manage your risk. But all that, the finality, has no point if you don't take your profits. If ever you are not able to press this sell button, and you will see that it is not as simple as that. If you think it's simple, I can assure you that you have never experienced what you are going to experience during a bull run, and that is really what this video is about. It is often said that the performance of a bull run, or at least of an investment, is the moment when you buy. In any case, that's what people, the majority, think. It's saying to themselves, I was able to buy the low point. Is this really the case? I want to tell you no, not at all, especially when I'm able to sell. Making X10, X100 all in all, it's relatively simple. Many people in the previous cycle or previous cycles were able to do them, but were they able to leave with their multiple? I can assure you that there are very few who have been capable. Very few people who have been able to take profits here, or even take profits here. Many people have come in with X10, X15, X20 and ended up actually in negative at the end because they were not able to sell their position for several reasons. And the first and most important is the notion psychological. You have to understand that when you are in a bull run, it is something which is even more complicated to manage than a bear market. It is even more complicated than looking at your portfolio at minus 50, because there it will perhaps be, see you, 150, plus 200, plus 300, plus 1,000, and there are in fact several psychological elements that will fall into place. The first will be the notion of grid. Remember that when you are in this bullish acceleration, you think like you are a genius, and therefore you are no longer inclined to say to yourself, I am going to sell because you are a genius. You have succeeded where others have not. Successful? And you are capable of being able to dominate the market. And don't think it's illusory, you'll feel it. I really invite you to note this video and to listen to this video again when we are in this phase of euphoria, because it goes with precisely this notion of grid which is going to arrive, that is, ire that you are going to be so euphoric to see your wallet bursting, which you certainly already feel a little bit now if you have worked well on this accumulation phase, and here we are all the same. On an X25, so we are already in this phase, a little bit of grid euphoria, which is already very present. It means we want more and we don't want to stop. Why sell now? Well, maybe tomorrow it will still be X2. Imagine I sell now, I take my X25, and tomorrow it's at X5, I would have lost my X5. And there we arrive in a feeling which is very contradictory, is that we will think about what we have won. So the X25, for example, if we sell now, but we are going to think about what we lost. It is, i.e., the movement which happened after the acceleration, after the moment when I sold the acceleration, which gave the result of after. And that's really symptomatic. It's something that you're going to feel enormously, and that's going to put you at risk, particularly on your first sales. That is, you're going to perhaps partially sell a position, so not necessarily here. That's not what I'm telling you. Be careful. Here we really are. In a notion of hypothesis, take into consideration that I am going to have a speech which will be more about theory, in which we will move into practice at the end of this video, in which we will come to really 4 major means to manage these profit-taking. Here we are really on the theoretical part, and that we are in a notion of spot and not in a notion of trading. These are 2 things which are separated. It is a management concept of profit-taking on spot, on long-term investment. I close the parenthesis. I am not saying that you have to sell now, but let's admit, if you sell part of your position now, maybe 10, 15, 20, 30, depending on the risk management you have at this moment, if we're ever going to accelerate, we're not going to say, great, I've locked 2.5. I've locked a multiple of 2.5 on X percentage of my capital. We will say to ourselves, but in fact I missed all that with the rest of my capital, and we will see the glass half empty rather than half full, and that is where we must be very, very careful, because it is where in fact we will no longer have the capacity to be able to press this little magic button, which is the sales button, which is the fact of realizing the profits that you make. Seeing your portfolio currently made up of cryptos evolve and accelerate. So remember that this is something that is temporary. As long as you have not transformed into USDT or USDC, into a stable coin, or even why not into a euro, in fact it is something which is imaginary. It is something which is not tangible. It is not, should not have realized. Understand that this is something that can fluctuate, which can very well accelerate or very well go down. And the only way to lock that in is really to make this active sale. You should never regret selling for a profit. No matter what happens afterward, you should never regret selling. Really, it is very, very important because it means that you forget the fact that you have locked in profit. And it does not matter that this profit is perhaps a tenth of the profit that you could have made if you had not sold immediately. Learn the lesson and put in place strategies to manage your sales and these things that we will see at the end of the video. Another thing that is important is that when you are in these very strong acceleration phases, here you are going to have a lot of noise. Whether on YouTube, on Twitter, you are going to have the new nuggets at X 15 million, you are going to have the new shitcoins, which will be magical. You will have the money printers like we were able to have with Wonderland, where you will have everything and anything that will happen, and everything will seem easy to you, and you have to be careful. Don't forget the original plan you have. This is why it is very important. When you understand that all this is going to happen, that emotionally you are going to be fragile like any human person. You are not infallible, so you are going to be emotionally unstable during this period. That's why you have to have a plan. You have to decide on your plan now, and even ideally a little in advance, but that you are always prepared for what you are going to do. What you need to do. You must write it down, it must be written, it must be limited, why not printed? It is really very, very important because if this is not the case, it is something that you will be able to come back to and which you are going to deviate from your plan. And the more you are going to deviate from your plan, the more you are going to put yourself at risk, and that is really important. So establish your plan, and I will give you the different phases to be able to process it, and to be able to see once again everything falls into a notion of risk management. Understand that this is the second counterpart of yesterday's video, so watch it yesterday. I explained to you generally risk management to be able to make multiples, and now we will talk about risk management in profit-taking to be able to validate the multiples of your overall investment risk management, okay? So if all this seems a little vague to you, don't forget that you have a free description and comment of the investment guide which is available, which is a 30 pages guide, which goes over how to buy, how to sell, psychological management, strategies, overall everything to be prepared to manage this. And in particular, one of the strategies that I am going to show you is present in this guide. If you want to go further, everything is available in comments and descriptions. So let's talk about the first thing. Already one is having a goal. I wrote that down to you, an objective. I talked to you about it yesterday. I'll talk to you about it again today. Whether it's quantified, whether it's in percentage. Ideally, quantified is better because it's tangible, meaning you know that at the end of your bull run you want to go out with so much. Make sure you can go out with so many. And I'm going to explain different methodologies to you and how to calculate it. You'll see it's very, very simple. So we are going to start with a method which is really the simplest, which is, not to say the Baba. If you have ever made an entry in purchase in DCA, you're going to make an entry in exit. Well, an exit rather in DCA, same. We will take the example of, here, Anchor, therefore the Anchor crypto. I spoke to you about it yesterday. It's the opportunity. It's very simple. There is a rule which is defined by Dow's law, which is the law of the markets, which defines a cyclicality of the market with a contraction and an expansion implied by the market to make it rapid and not go too far. But the market, in fact, is a form of cycle with expansion, contraction, and expansion. And what we actually want is in these phases of expansion and contraction are precisely making purchases and sales phases, and it's very simple inside. It is, in fact, we define a Fibonacci ratio. We take the 0.5, which is above the 0.5 of the total movement that we have already had. In fact, it is selling zones, and below 0.5 are buying zones. Quite simply, when you go below 0.5, that's where you trigger your buy DCA. When you go above 0.5, you trigger your sell DCA. Thereupon, the DCA itself will be timed and defined in relation to the multiple you want to make. So here I'm going to give you a concrete explanation of how to calculate that. It's quite simple if you want. For example, you have 10,000 euros of investment that you want to come out with. 1 lakh. This implies that you want to do 1x10, so on your entire capital you must do 1x10. On that point, it's complicated when you do DCA because quite simply you will come out with a certain amount perhaps at different multiples. It's very simple. Think in terms of sales percentage. That is to say that, for example, when you go above 0.5, you will look for 1x2. For example, we will be a little bit crazier. We will say you will look for here a 600. Okay, we're going to be even still. We're going to simplify the calculations. We're going to say you're going to get 1x5. Okay, so in this area, you're going to sell maybe 20 of your capital. These 20 are going to be multiplied by x5 because it's 1x5. So that means that on 20 of your capital, you have locked a multiple of 5. This is very important. So that means that here on the entirety of your capital, you are going to do 0.2x5. That means that you have done 1.1. What does that mean? That means that you have doubled your capital. Okay, it does not mean that you have made a multiple of 1. It means that you have doubled your capital. And the same we continue on, that we will look for the 88th. Let's admit we will look for a point a little higher, which will be 1x. Of your capital, you've locked in a multiple of 5. It's very important, so it means that here on the totality of your capital, you're going to do 0.2x5. It means that you've done 1.1. What does that mean? It means that you've doubled your capital, okay? It doesn't mean that you've done a multiple of 1. It means that you've doubled your capital. And likewise, we continue on this. We're going to look for the ATH. Let's say we're going to look for a point a little higher, which is going to be 1x10. Perspective, and this is also important, and this is continually valid for almost all assets and for all strategies. It doesn't matter what your exit strategy is, always keep a moon bag. So there, it depends on the person. It's between 10 and 20 of your ring, in which you keep a moon bag. Moon bag, what does that mean? This means that it is a set of cryptos that you will keep no matter how high the price goes. This means that you will only sell at the moment when there is a significant break, in which you have a break of structure, in which we see a reversal of the market where in effect you will cut a large part from your moon bag. Why is it important? Because imagine that on an asset, you are really on the very good asset, and that this asset is X100. Okay, you have 10 of this X100. Well, the same principle is 0.10x100. That means that you have, on your entire capital, make 1x10 with just 10 from your ring. So 15, that implies that you have done 1x15, and you understand that therefore, just the fact of having a moon bag in relation to the totality of what you have locked before will allow you to really have an increase in your multiples. Very, very important. And that's something you have to have, no matter in a form of DCA, no matter the other techniques that I'm going to show you after. It's something that you must have in mind and that you must systematically instantiate in your upstream strategy so as to be prepared to manage your multiples, and that is how you will define your exit policy. So to go a little further, we talked about the boat thing, which is the classic DCA. When we pass the 0.5, I start to sell little by little, and I define my amounts with my multiples to be able to have my total amount at the end of my bull run that I want to have. There is, after the part, a little more degenerative, which is I wait for the break of the minimum ATH to be able to do. So here it's very simple. We draw a Fibonacci extension in which I take the lowest point of the previous cycle. The highest point which was made, I make on the retracement here the lowest point which has been given. This will give me here 1 and 1/618, which are my first two targets that I will aim for. We can even be a little more conservative if we wish. Just go in style and add the 0.618, and we can say to ourselves that when I pass the 0.618, here I take here a part of profit, which allows me to lock part of my profits, so it can be 30 from my ring. For example, here when I break the 88th, I will take back perhaps 20 or 30 from my bag. We can reverse the two, of course. And then I'm going to take a big part of the profit when I reach the extension in 618. So what's the reasoning behind it? This is the reasoning once again of Dow's law, which is quite simply the general extension of the market. That is to say that we are in an expansion phase. So I'm going to look for this expansion phase to sell this expansion phase and keep a part afterwards for my moon bag to follow if I ever have following objectives like the 2,618, 3,618, etc., which are the Fibonacci ratios, which tend to still be well respected. So on that, a little tip, systematically, don't position yourself on a round number. Don't position yourself on a 1/618. Exactly. Always take a little bit below so as to be sure to be executed if you are ever in limit order, because it often happens that we stop just before. So we must always be prepared for that and always have a small margin, even if it means not selling exactly at the perfect price. Never try to have the top of the market or the bottom of the market. Those are really the default rules. We often forget them, but they must therefore be kept in mind. So we continue once again with another methodology, and there it will depend a lot on the way in which you manage it. Here we're going to go instead to BTC. It's going to be interesting because we're going to take the previous cycle in order to understand exactly how it works. And there you will see that it is totally different. I'm not going to try to make my sales, I'm going to try to support my sales. And there you will see that it is really very different. The goal is not to sell, it is not to take profit strictly speaking, it is to continue to build your position. This means that I have a bullish acceleration. As soon as I have a retracement or a lateralization, I buy back. All right? So quite simply, I made a first purchase, for example, here. My average purchase price is located here. I make a lateralization. I increase my position. So I increase my purchase price a little bit here. I accelerate again, the same. I have a lateralization. I have a retracement. I buy again in this zone, so I increase my price again. Okay, my average price purchase in real terms, all this will still be systematically. The increase will be quite small, but it remains an increase in your capital and above all an increase in your position and so on. When we arrive in this zone, at this moment, I will see that the literalization, here I can potentially buy back. There is no problem. And on the other hand, here I see that I have started to have a break of structure, so I have a potential sell signal. So here I am going to start taking massive profits, large portions of profits. I will wait until there is lateralization and structuring, something that we see here, in which I will re-expose myself with the profits that I made here mainly, and in which I will once again increase my purchase price to go back, okay, this is my average purchase price, to be able to accompany here the same, etc. Until I have here a break in which I partially take my profits. On this you will tell me yes. But all in all, your multiple is much less interesting. I agree with you, but except that when we actually look at the figures behind it, so it's the actual amount collected, the multiple is certainly much less impressive. But on the other hand, I multiplied the amount almost by 3, amount that I would have collected by this method. On the other hand, it implies 3 things. This implies that I have a strategy that is defined, and that I have the ability to manage my emotions upstream. Because don't forget, the start of the video. Secondly, it implies that I have capital that is ready and available for this. This implies that I am active in this part. It means that I am capable of detecting, of technically analyzing what is happening to understand what is happening and when I must take action. Massive profits or not, when I should buy or not. And that's the same. It requires training. It requires understanding the market and taking the time to analyze this market. There. So it really depends on who you are, risk management, and how much time you allocate to it. It's the same. That's why we have a private group dedicated to that to make it easier for you. That's why I made the investment guide available, which is free. And even the 60-hour training, which is financeable by a partner and therefore free, which is available in comments and descriptions. All this information is in comments and descriptions for you. Give the elements either to train you upstream for free to be able to do it, or to be with us to benefit from the different advice that we may have. The different information that we may have, because it's something that's going to be important. Once again, no matter your purchase area, no matter how you are going to carry out, if you are not able to take your profits, you will not be able to validate the multiples that you saw on your wallet. And so that means that it won't be of any use because you're going to feel bad. You tell yourself that you missed it, and then you're in a bias. Psychological, on which you will not be able to make a profit, and that is why you have to be really vigilant about that. That's why I'm talking to you about it now, because we had the pleasure during the end of the year to benefit from this acceleration, just as we had the pleasure at the start of the year, 2023, also to have this acceleration. We don't know if we will have a sell the news. We don't know if we will have a bull run, which will start in 2024. In any case, what is sure and certain is that you must, at the end of the year, at the beginning of the year 2024, define what your exit strategy is, what your strategy is, of profit, and write it down, put it in front of you, and be prepared no matter what. Whether it is a bullish acceleration, whether a bearish acceleration, you normally already have your purchasing strategy, your strengthening strategy. All you were missing was this strategy. It's up to you to design it. That's everyone's job. And if you ever think that you are missing information, don't forget the free investment guide available in comments and descriptions. And we'll see you next year. So I don't know if I'll make a video on Monday. In any case, what is certain is that it will not be early in the morning. That is certain. But in any case, I'll see you next year for lots of new things. I wish you for 2024 full of happiness, full of health, full of financial and entrepreneurial success. In any case, all the good things. If you've been with me throughout this bear market, I think we really deserved it this year. 2024, 2025. And we are prepared. In any case for the channel, what is certain is that I am preparing lots of good things for you, lots of surprises. And it is with pleasure that we will continue the adventure together, because it is with pleasure that I chat with you, whether on the Discord, whether on the private group, whether through the comments. And in fact, don't forget to leave me a little like and a comment. That makes me support, it makes me happy. And I wish you a very happy birthday. End of year and see you next year.